The capping of interest rates in October last year came in to check interest income, forcing banks to innovate alternative channels to deliver services to consumers. This has since seen banks minimize lending to reduce risk that would rather impact on their balance sheet.
Over time, the average risk of default for customers has been going down. See, when the credit bureaus were introduced, the average non-performing loans for banks was in the region of about 17%, as if you look back in the data of 2010. Today is averaging about 5.7, and credit uptake has actually increased, which means that more of the good borrowers have actually come out to access credit.
Credit reference bureaus now see a surge in loan uptake in 2017, especially from Tier 1 banks, which are holding 400 billion shillings, representing a 15% of the 2.8 trillion shillings consolidated bank credit.
Many of the large banks have liquidity that they really have to find a home for because it is costly liquidity. Remember, they are paying, for the first time almost, they are paying for depositors nearly 7%. So the banks have to find places to put this liquidity. So I expect the large banks will be pulling their socks and looking for customers. Otherwise, their P&L is going to be hurt very, very seriously.
Metropol projects that banks will increase their investment in government securities from the current 100 billion shillings within the next 6 months of the year, and advances worth 80 billion shillings to the private sector.
And we have already seen that movement. Quite a bit of liquidity has gone into public sector borrowing, but we expect accelerated uptake for the private sector for a number of reasons. One being that even the tools to make credit, for example on mobile phones, those tools have become much more prevalent and it is a lot more efficient. So we expect that this will happen.
The Economist further urged the country to watch her debt levels, which now stands at 3.6 trillion shillings. Overall, Metropol projects that the economy will grow by between 6% and 6.5%, supported by increased investment in roads, power generation, and completion of Phase 1 of the standard gauge railway. Ronald Willie, Business Insight.